Welcome to Equal Ground Headlines, bringing you your balanced coverage on trending top stories in Canada. Clear news deserves a clear signal. Hit like, hit subscribe, and stay grounded. Canada's economy is at a crossroads, and the Bank of Canada is treading carefully as storm clouds gather. In mid-April, the central bank held its benchmark interest rate at 2.75%. opting not to cut rates further amid growing uncertainty. This decision came after an extraordinary easing campaign, 7 consecutive rate cuts since last summer, that brought rates down a full 2.25 percentage points. Until recently, the bank had been in stimulus mode to counter a slowdown and tame inflation. But officials are increasingly wary of new headwinds, chief among them the U.S. tariff onslaught. In fact, minutes from the April policy meeting show the bank's governing council seriously debated another rate cut, but ultimately decided to pause, largely because of the unpredictability surrounding U.S. trade policy. Everyone agreed there was a great deal of uncertainty, and the situation could change quickly, the bank's summary noted. Members fear that continuing to slash rates without clarity on U.S. tariffs might be premature, especially since those tariffs could drive up prices on some goods, complicating the inflation outlook. Economic indicators on the home front give mixed signals. On one hand, inflation is close to the 2% target, relatively subdued despite years of global price surges. On the other hand, growth has clearly downshifted. In March, Canadian employment fell by 33,000, the first monthly drop in jobs since January 2022, nudging the unemployment rate up to 6.7%. Sectors like retail and recreation saw notable layoffs, and job losses were spread across major provinces. This pullback in hiring suggests businesses are feeling the pinch of the tariff war and general uncertainty. Exports have softened and some investment plans are on hold, validating those on the bank's council who worry the economy is weakening. At the same time, the Bank of Canada acknowledges that its past rate cuts are still working their way through the economy, supporting activity and keeping inflation stable. With core inflation expectations well anchored, a faction of policymakers argued they still have flexibility to reduce the policy interest rate further to support growth if needed. Others, however, wanted to wait and gather more data on how existing cuts are impacting growth and to monitor any upward price pressures from tariffs before easing further. For now, the bank has adopted a cautious stance, ready to move decisively if needed to keep the economy on track, but not preempting moves while the picture is so uncertain. Governor Tiff Macklem, leading the bank in this scenario, has emphasized that monetary policy must support the economy in the face of tariffs while maintaining its focus on price stability. That means policymakers are effectively on high alert. They have identified U.S. trade actions as a major two-layered risk, affecting both the demand for Canadian goods and potentially their prices via tariffs. In plain terms, Canada is simultaneously dealing with weaker growth momentum and the threat of tariff-induced inflation on certain imports. It's a challenging combination. The central bank's pause in April was thus a signal. They will neither overreact to 1 month of bad news nor ignore the clear risks ahead. Analysts expect the Bank of Canada to remain data-dependent. If upcoming figures show the economy sliding closer to recession, say, another spike in unemployment, or a contraction in GDP, rate cuts could resume quickly. Conversely, if trade tensions ease or fiscal stimulus from the new government boost confidence, the bank might hold steady longer. In short, Canada's monetary guardians are walking a fine line, aiming to nurture a fragile economy through a very uncertain time, with one eye on domestic conditions and the other on the tumultuous trade winds blowing from the south.